Welcome back to our Infinite Banking Versus series, where we break down financial strategies to help you make smarter money moves. And today, we're comparing the infinite banking concept to another very common financial tool, and that is Treasury bonds. So if you're wondering whether parking your money in the government bonds is the best way to secure your financial future, then just stick around for our discussion.
That's right, Jonah. We're going to evaluate both of these options using our 8 ideals: guarantees, constant compounding, liquidity, flexibility, privacy, taxes, rate of return, and passive income stream. By the end, you'll know which of these 2 strategies stack up the best for you. And hey, if you're finding this video helpful, please don't forget to hit that like button and subscribe for more financial insights.
So Treasury bonds, or T-bonds, have been around since the 18th century. They're issued by the US government to fund various national projects. Investors normally see them as one of the safest places to put their money because they're backed by the full faith and credit of the US government. And that sounds pretty trustworthy, right, Sean?
Well, Jonah, you know me and the government. Now, participating whole life insurance, which is the foundation of infinite banking, has been around for well over 150 plus years. Mutual insurance companies like New York Life and National Life actually pioneered these style of policies, offering stability through profit-sharing dividends with their policy owners. Now, the wealthiest families in America have been using whole life as a safe place to store and grow their money since the mid-1800s. But infinite banking as a concept was more recently popularized in the early 2000s by R. Nelson Nash when he began to help individuals leverage their policy's cash value as their own banking system.
So what exactly are Treasury bonds? They're long-term investments with a maturity of 10 to 30 years. Investors lend the money to the government, and in return, they receive periodic interest payments until the bond matures, at which point they get their principal back. Now, these bonds are often known for their safety, but they offer relatively low returns.
So infinite banking, on the other hand, uses whole life insurance policies to build cash value. Instead of locking your money away for decades, you can access it through something we call policy loans. Your policy actually grows steadily over time and isn't subject to any sort of market volatility.
All right, Sean, what do you say we get into comparing these 2, starting with the first of our 8 ideals, guarantees? Treasury bonds offer a guaranteed interest rate and return of principal upon maturity. This guarantee is backed by the US government, so this does make it one of the safest investments available. However, these guarantees come with modest returns. They may not keep up with inflation. Very low risk tends to mean low returns in most cases.
I gotta be honest, Jonah, I do like how safe that sounds. Luckily for me, infinite banking policies also provide guarantees. Your cash value grows at a guaranteed rate, and all the companies we work with offer a dividend that can further enhance the growth of your cash value and your policy. Just so you guys are aware though, dividends are not actually guaranteed. But we only work with companies with a track record of paying out dividends for 125 plus years straight. So, like I said, when talking about a dividend, it's not guaranteed, but you get what I'm saying.
With Treasury bonds or T-bonds, compounding only happens if you reinvest the interest payments. Otherwise, the compounding effect is interrupted, which is okay. I mean, I do like constant compounding, but what if I decide I want to use some of the money?
Yeah, I definitely agree, Jonah. Constant compounding is great, but I'm going to do you one better. Infinite banking offers uninterrupted compounding, meaning if and when you decide to borrow against your policy's cash value, the policy continues to grow as if the money was never touched. That is a game changer for building wealth over a long-term period.
Gotta be honest, that's a pretty nice feature, Sean. So next up, just like I had hinted at above, is liquidity. Liquidity can be an issue with Treasury bonds. While you can sell bonds before maturity, their value fluctuates with the interest rates, meaning you might not get your full principal back. Additionally, accessing funds early could mean losing out on the future interest payments. So there's definitely some liquidity there, but not a whole bunch.
Some liquidity is good. A lot of liquidity sounds better. Infinite banking policies offer near immediate liquidity through policy loans. You can also access your cash value without penalties and use it for any purpose, no questions asked, making it a much more flexible option.
Speaking of flexibility, T-bonds can be fairly how do I say it, rigid. So once you've purchased them, your money's actually tied up for that set period unless you're willing to sell early, which like I just mentioned could result in that financial loss. Essentially what I'm saying is once your money is in there, it's in there, stuck. It's more of a one-way door compared to a revolving door.
Yeah, I definitely see infinite banking more as that revolving door. These policies are designed for flexibility. You can borrow against your cash value for investments, emergencies, or large purchases. Plus, you're in control of the repayment terms. I'm talking about like 100% control of if or when you pay back the loans that you took out. Where else can you find something like that?
That is definitely a unique feature. So let's discuss our next ideal, which is privacy. Treasury bonds are government securities, meaning your transactions are monitored and recorded, right? For quality assurance purposes, you get it. To say there's limited privacy with these investments would be a bit of an understatement. I mean, they're called treasury bonds, government bonds.
Well, Jonah, infinite banking policies definitely prioritize privacy. When it comes to IBC, because we're dealing with life insurance products, privacy is a key component. For example, all of your transactions are 100% private. Policy loans don't require credit checks or any sort of external approval, meaning they don't show up in any database, unlike other loans if you decide to take those from elsewhere. The majority of states also view this style of product as an asset that can't be touched through liens or lawsuits, giving you greater financial confidentiality and safety.
As always, everyone's favorite topic, right? Taxes. And it appears, you won't be avoiding them here. Interest earned on treasury bonds is taxable at the federal level, but it is exempt from state and local taxes. However, of course, these taxes will reduce your net returns overall.
I do think taxes are extremely important, but if it's possible to give away less of my money, I'm definitely about that, which is one of the reasons why I like IBC so much. You see, infinite banking policies grow tax deferred, policy loans are tax free, and the death benefit is paid out tax free to your beneficiaries, meaning no one will need to deal with this asset going through probate, making it a highly tax efficient wealth building tool.
Treasury bonds offer low to moderate returns. While they're safe, they may not outpace inflation, which could defeat the whole purpose, and it really limits their effectiveness for long-term wealth building.
On the other side, Jonah, infinite banking focuses on steady, predictable growth. While it may not provide high short-term returns, the combination of guaranteed growth and potential dividends can outpace inflation and support long-term financial goals. Because liquidity isn't an issue, what you do with the money in your policy matters. And that's when and where we as bankers begin to focus on the rate of return topic.
Treasury bonds provide passive income through regular interest payments. However, the income is limited by the bond's fixed rate and the term. So at the end of the day, it does check the box for providing passive income if you continue to take the principal and continue purchasing bond after your term is up. Just keep renewing them.
If that's what you're looking for, it doesn't sound like that bad of an option. When it comes to infinite banking, policies can generate passive income through strategic policy loans or withdrawals in retirement. Because the cash value continues to grow, you can rely on a consistent income stream without depleting your assets.
So as we wrap up this video, I feel as though treasury bonds are a really safe option for preserving capital. But their low returns and limited flexibility can make them less appealing for long-term wealth building.
I agree, Jonah. Infinite banking, on the other hand, offers stability, growth, and control of your finances. So for those of you looking to build wealth while maintaining access to your money, this could definitely be a compelling alternative.
As always, we are here to help you decide what's right for your personal situation. So if you're interested in chatting, feel free to book a call with us. Here's what you do. Use the link in the description of this video. Select the button, book a call. It'll be me or Sean. You'll get one of us. We'll dive deeper personally into your financial goals. If you've got a bunch of treasury bonds, T-bonds, and you want to talk about it, let us know. If you just need to leave a comment below and get us to answer your question, we'll do that too.
Thanks for watching, guys. Please don't forget to like, comment, and subscribe. Let us know what your thoughts are and which of these 8 ideals matter the most to you. We'll catch y'all in the next video. Peace.